Hey, welcome back. So today we need to talk about 2021 tax planning. We've got a very short window of time to make these Roth conversions happen before December 31st, and I need to make you aware of some pitfalls to make sure that you don't over-convert and make sure that you're aware of the opportunities and the benefits of converting. So let's get started into this detailed conversation. Hang with me. I'm going to try and explain the different parts and pieces that you need to pay attention to and be aware of, so that you can make the most out of your tax dollars. So we're going to go over a scenario. It's a married filing jointly scenario where the individual couple has $80,000 in wages. In the prior year, they had more wages. COVID basically resulted in a shutdown of one of the businesses, and so they were not able to earn as much money in 2021. So we're in a year where our income is down. Now, in this particular scenario, we're going to go over assumptions that there are $80,000 of taxable W-2 wages, $2,500 of interest, dividends, and $40,000 of other self-employment income, a business that basically the couple started. The combination of those items results in a total income of $122,500. From that total income, we get to deduct some things, one of which is our self-employment tax, or half of our self-employment tax. So basically, add and subtract those numbers, you come down to this magical number called adjusted gross income. AGI is how it's abbreviated here. That adjusted gross income is a critical threshold, and it will change your tax situation when you go over certain amounts on that adjusted gross income. So what we need to talk about is, in this particular case, married filing jointly, the adjusted gross income threshold we're concerned about is $150,000 to $160,000. Those same thresholds apply for our single and our head of household filers. So you'll want to make sure that you know, one, your filing status, and two, those threshold amounts as you do this technical planning. So our adjusted gross income of $119,674 is then reduced by a number called qualified business income deduction, because we tried to start a business. That business was profitable. That deduction is a reduction of your income that's subject to federal income tax. From that, we also have our itemized deductions, which in this case exceed our standard deduction for a married filing jointly couple, $25,100. Itemized deductions are made up of our taxes, state and local taxes or sales taxes, real estate taxes, to the tune of a cap at $10,000, plus our mortgage interest, plus our charitable contributions. When those amounts exceed our $25,100 threshold, we're going to itemize. This couple, $35,000 in itemized deductions reduces their adjusted gross income to arrive at a taxable income number. That taxable income number is how we calculate our federal income tax. The self-employment income is how we calculate our self-employment tax. Those two taxes combined total $14,523. Let's carry on into the assumptions for this couple. We have mom and dad, two children under the age of 18, and one child at college. And so the two children under the age of 18 are going to have a $3,000 child tax credit. The one at college is going to have a $500 child tax credit, for a total of $6,500 child tax credits. Now, 2021 was unique because you would have received an advanced child tax payment. The IRS was required to pay that money out to the American public between July of 2021 and December of 2021. You could have gone onto the IRS website and declined that advanced child tax credit payment. If you didn't, then you received that amount. That amount could be changed once you filed your tax return for 2020. You're going to get a letter from the IRS. That letter is going to tell you what your advanced child tax credit payments were, and that's going to be important in this conversation to understand. You're not going to get the full $6,500 credit. That $6,500 credit is going to be reduced by the amount you already received. Okay. The next piece of the equation is our recovery rebate. That recovery rebate becomes an important conversation because it is going to be modified when your adjusted gross income exceeds these certain thresholds. In this particular case, we have $1,400 of this economic impact payment, number 3, is how it'll be referred to in short, EIP3. That is going to come back to you as a refundable rebate if you didn't receive any of it. So in this particular case, we've got a married filing joint couple who basically had income on their 2020 return that was too high for them to receive this economic impact payment. So they didn't get any. But when they file their tax return for 2021, because we're in a lower income year, they are going to get credit for this economic impact payment and receive that money as a refundable credit, meaning if they don't have enough tax to cover that, they're going to receive a refund. We'll talk about the 3 different scenarios following this once we establish the baseline and how that recovery payment gets affected when our adjusted gross income exceeds different dollar thresholds. So in our scenario here, our tax minus these credits, minus the adjusted advanced payment for the child tax credit, we have tax after credits of $4,023. This couple had $15,000 withholding of their federal income tax wages from their W-2, and so they're going to be due a refund of $10,977. Now, if they have other resources and they're not expecting that large of a refund, we have an opportunity to offer this IRA conversion money and reduce the amount of our refund and use the federal tax dollars to essentially pay for that conversion amount. Now, why would we want to convert? Your traditional IRA or 401k money that you have in an account for retirement is going to be taxed to you when you draw that money out, as opposed to a Roth IRA that is not going to be taxed to you when you draw that money out. So that Roth IRA is a never tax bucket of money. $10,000 goes in today, it grows and it becomes $20,000 when you retire. You pull that $20,000 out, you pay 0 tax. It does not affect the amount of Social Security income that gets taxed. It is 100% tax-free withdrawal from your retirement account in retirement. So we like to have people who have different buckets of money to draw from retirement. Their own individual savings, their pre-tax accounts, their IRAs or 401ks, and their never tax buckets of money that work with them and can be used essentially to maintain their standard of living as well as maintain their tax rates in certain thresholds. Let me set up the scenario for option 2, where we do some conversion amount and show you the impact of that conversion in this situation. Okay, so we basically have a $19,000 IRA conversion essentially established in this situation. Same, all the other facts are exactly the same, just adding $19,000 to our income. We didn't receive it, but what we did is we moved it from one account to another. When we do that, we expose that money to tax. So here's the situation. When we expose that $19,000 of tax, yes, it increases our adjusted gross income to $138,000. Yes, it increases our taxable income. Yes, it increases our tax. So our tax moves from $14,523 to $18,321. So yes, we are offering more tax, $3,000. When we do that conversion, our refund goes from $10,977 down to $7,179. Our effective tax rate in scenario 1 was 5.2%. That's our tax divided by our taxable income. When we convert $19,000, our effective tax rate moves from 5.2% to 8.1%. I'm of the opinion that's pretty cheap money. If you believe your tax rates are going down in the future, then go ahead and turn the video off, and that's fine. We can agree to disagree. But I'm of the opinion that our tax rates are going to go up. In fact, as we sit today, in 2026, we are going back to the old tax rates from 2017. So we know for sure, as we sit today, our tax rates are going to go back up. So let's set the scenario for options 3 and 4 so that you can understand how these thresholds can make a thousands of dollar impact on your tax return. So what I've done is I've basically pushed us to the threshold for this AGA phase out so that I can show you the impact and the dollar impact of a miscalculation or wrong decision. In this first column, option 3, same fact pattern, but we're going to convert $30,327. That takes us into the AGI of $150,001. When the AGI is $150,001, Our recovery rebate is cut in half. We just cost ourselves, by going over by $1, $3,500 in tax money. That's the issue that I need to make sure we explain in detail and that people understand. Don't go over that threshold. By reducing our IRA conversion by $1 and keeping our adjusted gross income at $150,000 or less, the economic impact payment number 3 is not affected, and we still end up with a refund from the Internal Revenue Service of $4,687, $4,687. So a $30,000 conversion cost us maybe $6,000 in tax. It's a significant impact. Your effective tax rate's 9.6% in that scenario, whereas a dollar difference when you over-convert or mess those projections up can cost you thousands of dollars in tax, and now your effective tax rate's 12.8%. So make sure those calculations are tight. Make sure you understand the game. Make sure you understand those thresholds that you don't need to go over. If in this event you happen to have a working spouse and a non-working spouse, it's possible for you to do some what I call post-mortem tax planning. Basically, this is tax planning that can take effect in January of 22 to April 15th of 22, where you can make an IRA contribution for that non-working spouse, and you can actually drive that adjusted gross income number down to $150,000 and not lose the $3,500 of your economic impact payment. So make sure you're planning well. Make sure you make the most out of those tax dollars and you understand the game and you play it well. Good luck.